Dodd-Frank still has a lot of measures that need to be implemented, a lot of things that need to even be decided. So where does that leave you in terms of the regulatory structure?
Well, obviously, Dodd-Frank was responding to a crisis. It was put together in a crisis environment and directionally needed. You know, the more oversight, more capital requirements, more provisions regarding how these institutions might be wound down in a future crisis, all important directionally. But a lot of the blanks still need to be filled in. And, of course, markets don't like uncertainty, and they don't like overburden. And there's concern that the future of Dodd-Frank could touch those two tripwires.
What's the worst-case scenario? And is it at this point freezing banks from doing more lending as they worry about what they're going to be required to do?
Well, it's not freezing banks from doing more lending. They are doing more lending, but there's uncertainty in the regulatory landscape. And, of course, when people are deploying large amounts of capital and try to plan structurally and strategically for the future, they want the rules of the road to be clear, and that's currently not the case.
Is it having an impact? Lending may be happening, but is it happening at the same pace it would be without clarity?
Well, an example, one of hundreds of examples within Dodd-Frank. There was a recent rule that came out called Qualified Mortgages, QM, that was promulgated by the Consumer Financial Protection Bureau. It put some rules of the road out. Now, overall, not a bad set of regulations. There's some concerns and some tweaking needs to be done, but it says to the industry, if you want to make qualified mortgages and you don't want to get dinged legally for them in the future, here are the objective requirements you have to follow. That gives the industry some certainty, some reliability, some predictability. Those kinds of declarations are actually helpful and constructive.
So it's a good thing.